Okay, great. Thanks for the reply. So we'll start right now. Sorry for the delay from Monday. We have some technical glitch from our side. So for this week's webinar, I'll be covering three broad topics. So first one, I'll be covering the US side of things. We'll be covering the update on the recession tracker, after which we'll cover the Singapore strategy outlook, and then last but not least, some company updates from Micromechanics, Capitaland, Retail Trust, and then from SIA Engineering. So in terms of the monthly recession tracker wise from the US, what we are seeing, at least from the movement last month, in terms of the recession tracker right now, all remains well from that perspective, except for one indicator which I'll elaborate more in the following slides. So what we saw last week, there was actually a huge move within the equity market, as well as on the flip side, we saw large spikes within the VIX index. We'll explain more in terms of what the implications are for the VIX index movement. But as of right now, on the screen, you can see this is the recession tracker. So for those that haven't been following us, the recession tracker basically shows a list of 15 indicators, which includes macroeconomic data, technical data, as well as market-based data. And as of now, only one indicator has actually flashed red, which is the market-based indicator from the VIX index. So from our study, we've seen that the threshold that actually signals some kind of a market panic and turmoil, the threshold that we observed was if the VIX index spikes above 27.7. Sorry, okay, you guys are not seeing the slides. Hold on a second. Okay, sorry for that. So hopefully y'all can see the slides right now. So here's the first slide, the recession tracker. So probably I will just reiterate what I was saying previously. So recession tracker wise, these are the 15 indicators that we are watching, and right now there's only this one that is flashing red, which is the VIX index. What happened was last week we actually saw minor moves within the VIX index, and ultimately the move that actually caused the triggering of this threshold was the last Monday night movement, whereby we saw the VIX index actually spiking above 100% in a single day, which then confirms this particular index as triggering its threshold for this bearish signal. But as of now, the rest of the indicators are still providing strong growth. And in terms of outlook-wise, for us to actually call for the market top, I think we would still need further requirement, further confirmation from the rest of the indicators for us to get a more convincing outlook from calling a market top. And all in all, in terms of market outlook-wise, at least in the long term, I believe the equity market still has further room to grow, even after the most recent sell-off that we have seen. So in terms of duration-wise, I'll explain why we see about 8 more months of upside in the equity market before some form of real weakness actually comes into the market. So for the next two slides, we'll just point out some of the bad and some of the good data that came out from the recession tracker. So here's one of the data that is weakening, the UMISH Consumer Sentiment Index. So basically it tracks consumer sentiment. And what we are seeing right now is, you can see bottom panel on the chart shows the UMISH Consumer Sentiment, top panel shows the S&P 500 index. What happens is, you can see historically when the UMISH Consumer Sentiment actually breaches its multi-year uptrend line, that kind of a break in trend actually coincides pretty nicely with the market top. So this also happened in somewhere around Jan of 2001, whereby the dot-com peak was kind of signaled by the break of the multi-year uptrend line and consumer sentiment. Same thing happened in around 2005 to 2007 each period. We saw the break of the multi-year uptrend line, which actually ushered in the top within the GFC. So right now we have seen this particular uptrend line form back in 2011 and stretching all the way until right now, and we are right now kind of sitting at this particular threshold at around 94.0. So all in all, in terms of data wise, this is the only weak economical data that we are seeing, and to get ourselves a better sensing of where this is heading to, we actually still rely on the other two consumer sentiment index tabulated by Conference Board as well as Bloomberg. So these other two indicators are still showing pretty good growth. They are still at a multi-year high, kind of different from what the UMISH consumer sentiments are showing. So all in all, continue to watch this space to see if this particular consumer sentiment index actually breached below this threshold. And for us to get a more convincing view of market weakness, we need to get more confirmation from these other two indicators, the Conference Board as well as the Bloomberg consumer sentiment, to actually at the same time trigger its particular threshold in order for us to call for sustained weakness. As of now, it's not showing. which is why we are still kind of a bullish, at least in the long-term perspective. And some better data point, unemployment claims are still showing pretty strong health. And what I mean by that is you can see since 2010, unemployment claims have been plunging to record lows. And more recently, we've seen the unemployment claim actually hitting a low of 216,000 new claims in a week. And that was actually the lowest point since 1973, to show you how strong we are in terms of the unemployment numbers. And this is only not showing within this space. In terms of unemployment rate, it's also showing that kind of a picture, whereby unemployment rate, last Friday we got the data, was still at 4.1%, which is the lowest since around 2001. So all in all, in terms of employment side of things, it still shows pretty decent growth. And for this particular slide, we'll be covering the recession timeline. So how we actually get the time frame of 8 months. So on the chart, you see the top panel shows you the 2-10 spread. The bottom panel shows you the Fed funds rate. And there's an interesting correlation between these two particular indices. So there's actually an inverse correlation between the Fed funds rate and the 2-10 spread. And what happens is at the rate hike cycle, what happens is during the rate hike period, you can see a 2-10 spread usually inverts along with it. And just to illustrate what I mean, you can see somewhere around in 2004, that was when the Fed actually hiked its interest rate during the housing boom period, lifting rates from 1% to 5.25% over a time span of 2 years. And you can see during that period, what happened was the 2-10 spread actually fell along with it, falling from a high of around 150 basis points all the way down to 0 and into negative territory. So one of the reasons why we look at 2-10 spread so closely is because it gives us pretty good sensing for a recession when the 2-10 spread actually falls below the 0 line. And in proxy, when the 2-10 spread falls below the 0 line, it's actually signaling to us that the yield curve is inverted. And you can see over here, the vertical bars are the point whereby recession comes into the market. It usually happens right after the 2-10 spread actually falls below the negative territory, on average about a 1-year lag. So right now, we are currently in a new rate hike cycle regime. Since December of 2015, we saw rates moving up from 0.25% to the current high of 1.5%. And according to the Fed's dot plot projection, they're expecting 3 more rate hikes this year. And even according to the Fed Fund Futures, which is a market implied interest rate probability, right now we are still seeing an 80% chance of a rate hike in March. So all in all, you can see the rate hike trajectory right now is still pretty much intact. And if the Fed were to follow through with the 3 rate hikes this year, then we believe that this downward trajectory within the 2-10 spread should continue to play out. And hence, we came out with some extrapolation within the data set, and what we have seen is using the kind of benchmark right now at 55 basis point during this 2000-ish period, it took the 2-10 spread around 35 weeks before the 2-10 spread actually falls below 0. And then another extrapolation that we did was the most recent flattening of this particular period back in around 2016, 2017, when the 2-10 spread was trading at a high of around 150 basis point. The market took around 30 weeks to actually flatten 50 basis point. So all in all, in terms of our base case scenario for the 2-10 spread to actually falls below the danger zone of 0, it still tells us that we are still kind of 8 months out before we see the inversion of the yield curve. And like I mentioned again, even after the yield curve inverts, it does not necessarily cause the market to roll over immediately. Markets still require at least 1 more year of kind of a gyration before the recession kicks in. So all in all, in terms of timing for the market for a turnaround, we still see further room to go within the market for at least another 8 more months out before this yield curve inverts. And after which, probably another year for the market to go through some volatile period before the market forms its top. Some interesting point to note for the S&P 500. So here's the S&P 500 on the monthly chart. Main emphasis here is to point out the relative strength index. So the bottom panel over here shows you the relative strength index, which measures momentum, how overbought or oversold we are. So all in all, you can see over here, we are right now in an extreme euphoria kind of a state, whereby the most recent reading in January for the RSI is at 88, kind of unprecedented per se. And what happens is that for the monthly basis, the RSI hardly breached above 70. I mean, usually it is above 70, it's usually in a kind of a euphoric state, and some kind of big market correction is likely to happen. So for example, during the dot-com period as well as the GFC period, we saw a respective high of 72 and 79 in the RSI before the market tops over. But having an overstretched RSI doesn't necessarily tell us exactly when the market might turn over. For example, during this whole period over here, since 1995 to 1998, the RSI was over and above 70 for a whole long period of about 4 years or so, and you can see the market continue to climb higher. So in a way to sort of filter us out from all this noise, in terms of calling for the market top for the weakness, we definitely have an overstretched RSI right now. But the triggering point from our perspective from the price action side is to watch for the S&P 500 to close below the 10-month moving average. And as of now, the critical threshold of the 10-month moving average is at 2,571 points. So what I mean by that is, you can see I've highlighted this particular point over here as well as this point over here to show you how the close below the 10-month moving average actually calls for the market top. So this was the point whereby the S&P 500 actually closed below the 10-month moving average. Together in line with the overbought RSI, it kind of gave us a pretty good sensing of a top-ish kind of pattern, and same during this GFC period, whereby this bearish close below the 10-month moving average, together with the overbought RSI, actually caused this particular market to turn around. So right now with the 88 overstretched RSI, the kind of a triggering point for the market to turn around from a price action perspective is to watch for the price of the S&P 500 to actually close below this 2,571 points, which is the 10-month moving average. As of now, yeah, it's definitely not happening. So we continue to watch this space in terms of the RSI and the price action. And bringing you guys more into the most recent movement. So there has been a lot of talking about the VIX index and how it has been triggering all this volatility in the market. So there was actually a 10% move within the S&P 500 recently, but the main action actually came within the VIX space. So the volatility index actually shown quite a lot of crack signs and vulnerabilities. And what I mean by that is small downlines in the S&P 500 index actually led to huge massive spike within the VIX index. So somewhere last year we saw 2 episodes of that, whereby in October and November we saw like respective 1% drop in the S&P 500, leading to a spike in 32 and 40% within the VIX index. And more recently last Monday and Tuesday, we saw the S&P 500 shedding only 2%, but the respective move within the VIX index was actually a 40% move to the upside. And then most recently last Friday and this Monday itself, we saw the S&P 500 index actually shed 6.5%, but on the flip side, there was an explosive move within the VIX index. So VIX index during the period actually spiked 170%, which is a very large move by itself, triggering a lot of volatility back into the market and causing a lot of panic selling to the equity market. And what it entails moving forward is, from our study, we see that large spikes like this usually don't last. But the reason for this sharp spike was mainly due to the over excessive short within the VIX complex. So according to the CFTC report, we are seeing unprecedented amount of shorting that's been happening since the whole of last year, 2017, which is why VIX has been trading at a low of 10 throughout this whole period over here. And this whole period over here is definitely signaling to us there's too much over complacency within the market, and sharp spikes like these are just imminent and waiting to happen. So all in all, in terms of the sharp spike wise, we believe this has a sort of a flush out all this extreme euphoria, and moving forward we expect the VIX index to actually go through a period of normalization. So probably I'll just run through in terms of how we use the VIX index for those that haven't really seen our recession tracker. So in order for us to get a sensing to kind of use the VIX index to time for the market top, here are some of the criteria that we watch to highlight troubles. So 4 criteria need to be sort of met before we would actually be more firm to call for a market top. So first, the VIX needs to consolidate around the 10 euphoria floor, and then we need to see sharp spike above the normal paradigm upper threshold. And for point number 3, the VIX needs to set a new panic floor at around 16 each level, and ultimately to see a second retest of the 16th floor to confirm the sustained weakness. So to put things into perspective, here's the .com case study. S&P 500 at the top panel, VIX index at the bottom panel. And as you can see over here, the VIX index during this whole period has been trading pretty nicely in a contained range since 1993 to 1997. And like I mentioned, point number 1 is the euphoria floor that you need to see. So back then, over complacency was being shown by VIX trading around the 10 euphoria floor. And ultimately, once we get anomaly spikes, when we breach through the upper threshold, shown by point number 2, that is actually the first red flag to the market that something was amiss. And ultimately, when point number 3 sets in, when you move from a euphoria floor to a new panic floor, moving from 10 to 16, that is more or less a done deal that the market has shifted from one complacent paradigm to a paradigm that has signaling some form of weakness. And ultimately, point number 4 is when the market actually forms its respective top. So this is during the dot-com period, whereby the second retest of this floor actually form its respective high within the dot-com bubble period. And then for the GFC case study, it's pretty much similar as well. So for the whole period of 2003 to 07, the VIX index traded pretty nicely within this range of around 9.11 to about 23.81. And same thing again, to show extreme euphoria, the VIX index needs to actually bottom bounce around this 10 euphoria floor for a prolonged period first. And ultimately, once we have that particular criteria set in stone, then triggering of the upper threshold will give us point number 2 to sort of move into a new change for the structure of the market. So you can see the red highlighted area shows the anomaly spikes above its normal threshold, and ultimately again to watch for the floor resetting at a higher level. So moving from 10 to a 16 kind of a floor gives us a sustained weakness kind of a sensing, and ultimately point number 4 is to see the second retest of the 16 floor. So this vertical line marks the point where we saw the second retest of the 16 floor, and ultimately that confirms to the market that it's going through some sort of turmoil, and ultimately the market crashed 50% along with it. So in terms of where we are right now, I would say we are just right now in stage number 2, which then requires us to actually go through stage number 3 and stage number 4 before the market rolls over. So and just to give you guys a sensing of what's been happening, so since 2012 we have been moving pretty nicely within this contained range. 27.7 is the threshold that I was mentioning about, and in order to show the euphoria that we have been seeing, it happened last year, 2017, whereby the VIX index traded pretty nicely stuck within the 10th floor for a prolonged period of time. So moving forward right now, we are seeing this anomaly spike above its threshold. Recently spiked to a high of around 50, and moving forward what we expect is that the VIX index should continue to normalize, and in order for us to call for more structural change within the market, we need to see the VIX index actually renormalizing back to a new floor. Instead of seeing it building a floor at 10 each level, we would expect the VIX index to actually move to somewhere around the 16th floor for us to call for a structural change. And ultimately, once the 16th floor is being built, then a retest of the 16th floor is needed to sort of pinpoint the market top. All in all, for that to happen, I think at least for the VIX index perspective, it could still require another 8 more months out before we see that kind of price action playing out. So all in all, in terms of calling for the market top, definitely right now is not the point. So this anomaly spike not necessarily is calling for a top, but instead going through a normalization period actually cause the S&P 500 to actually move through another period of upside first before we see that kind of a market top. So last but not least, in terms of the near-term price action, here's the S&P 500 index on the daily time frame. So what we have seen is most recently the sell-off since last week. The reason for the sell-off was again due to the over excessive buying within the equity market. For the whole of 2017, the S&P 500 has been moving pretty nicely to the upside without experiencing any sharp correction. And ultimately, the sharp correction actually came in somewhere around this week and last week. So partly it can be seen by the RSI actually hitting a new record high of 88, which is signaling extreme euphoria. So ultimately, when that actually sets in, you can see what happened to the market. During this whole period of this particular record high, the S&P 500 actually wiped out around 12% of this move. But what is showing right now, especially from the price action yesterday, there is actually some sign of recovery coming to the market. So we saw market crumbling down to this particular low, but there is some support of this 2,555 points area. At the same time, there is also this 200-day moving average that has been holding price up, which is this green dotted line. So all in all, in terms of price action wise, this particular big hammer that we're seeing right here, together with the RSI hitting a new low of 25, which is oversold, probably the market might be actually going through a period of stabilization moving forward. And we believe this particular uptrend that we have seen since 2017 should continue to move on higher, as the recession tracker right now are still showing pretty strong growth, and calling for at least 8 more months of upside within the equity market moving forward would more or less bring the S&P 500 back to the previous high of around 2,850 points for the S&P 500. So in terms of near-term price action as well as long-term price action wise, recession indicator, all still kind of signal pretty strong growth moving forward for at least 8 more months or so before we see some form of real weakness. So in summary, at least for the US equity market, the panic selling that we see since last week more or less still stay intact for the market to actually climb higher. We are actually seeing the price action that I've shown you to call for a rebound back into the uptrend. And we believe the US equity market should continue to step higher moving forward until our recession tracker actually triggers more of its respective threshold. So for those that haven't been following the recession tracker and want to know more, you can actually follow these 2 particular links to get an idea of how we actually decipher each and every single indicator to pinpoint exactly when the market might turn over. Yeah, and with that, I'll pass the rest of the time to Paul to talk about the Singapore strategy update.
Okay. Hi. This is Paul here. Just a quick update on the macro situation, or what has actually transpired. What we saw was that on Friday, at least the U.S. Treasuries actually hit a 4-year high, 2.85%, and this probably was the main trigger for the sell down. In what had happened was that in the background, as we all know, there was a very healthy global growth, and as the Fed was also unwinding its 4.5 trillion balance sheet. 2018 at least they will be tapering at least 250 billion. So both these factors were already nudging up interest rates, but there were new pressure points that came up. Friday itself, the big news was obviously the wage growth numbers. There were actually 8.5-year highs. Then in the background, we also had like the Trump tax cuts. Then we had and inflation expectations were rising because of the weak commodity and also because of the strong commodity prices and the weak US dollar. And it did not help matters on the political front. At least the Treasury Secretary had some comments that they welcome a weak US dollar. That again stroked inflation fears, and also in the State of Union address, Trump mentioned 1.5 trillion infrastructure spending. What's important is that this spending seemed to be unfunded, so this could actually balloon the deficit situation in the US. So all this combination of factors actually caused the interest rate to spike to 4-year highs, and also inflation, the 10-year inflationary expectations. So we think that was the main trigger. And as you know, all asset prices, asset values at least are anchored off interest rates, and obviously equity markets were affected. On the third point, we said there was no bond market rout. There were 3 historical time periods when we saw a big sell down in the bond markets. In 1965-70, when inflation actually rose from 1 to 6, and wage growth was actually 6%. Obviously, we are very far from it. Inflation now is about 2, and our wage growth is only I think 2.9%. So we are far from hitting these kind of levels. The other time when we had a big sell down on the bond markets was 1994. This is somewhat similar to the taper tantrum. Basically, there was poor communication by the Federal Reserve, and they did a preemptive increase in interest rates, and that kind of caused the market to panic that the authorities were looking to tighten monetary policy. So that was another trigger for the bond rout. The third one was more technical thing, because the Japanese banks were holding a lot of government Japanese bonds, and as a result, the huge volatility caused them to do a VaR sell-off. Basically, VaR is basically a measurement of the daily losses. So that actually caused, because of the wild swings in the surge in treasury yields, or the decline in Japanese yields, it caused them to technically sell off, to unload their bonds. So that actually worsened the situation. Again, these 3 situations, we think it's not happening right now, so that's why we don't think there's a big bond market rout. In terms of going back to Singapore sectors, again, the sectors that we still like is like banking and property. In terms of the stocks, no major changes. I guess the only one will be like yield, be like as Asian Pay TV, Ascenders, and Property Capitaland Chasing. These are the usual names, and of course, we had new initiations the last 2-3 weeks, which is Y Ventures and China Sunsin. The new name that we put in here is actually SGX. I think the big spike in volatility would be the big beneficiary would obviously be SGX, especially with the derivative, with the big derivatives business that they have. And do note that yesterday's volume was about 2 point something billion, and this was actually a 4-year high. So SGX could actually get a twin tailwind, which is the volatility for derivatives and also the volume increase in volume from the SGX itself. So that's probably a new tactical idea that investors may be interested in. Okay, that's it for our Singapore strategy update. I will move on to our results commentary. As you know, Micromechanics released their results. We did downgrade it into accumulate because at that point, because the share price did appreciate and was close to our target price, so the upside did not warrant a buy. Anyway, on the results itself, in the second quarter, which is the December quarter, they did hit a record quarter for them. And actually, the positives was that they have one business in the US, which is the front end business. This is the business that would actually drive the next 2 to 3 year upside for them. So that is making headway. So that was a positive, and they also raised their dividends by 33%. Okay, the negative for us was that the second quarter disappointed. We were looking for around 20+%, but the growth came out at 10%. I think what has happened also, the currency did play a factor, probably 2 to 3 basis points. It did hurt the momentum. Anyway, so we reduced our forecast by 7%, mainly because we are a bit more careful as we move into the first quarter and second quarter 2018, calendar 2018. So we just want to see whether the semiconductors momentum can be maintained. And that's why we said that we are concerned the comparisons get harder as we approach calendar 2018. But nevertheless, we still like the company. It still has amazing numbers, metrics. The ROE is more than 30, around 60% gross profit margins, and it's also a net cash balance sheet, and with with almost 4% dividend yield. And I think this could probably hit 4% because they're probably going to raise dividends. So we're just assuming dividends are flat. So anyway, we still like the company, but just that due to the price performance, we downgraded it. Okay, I'll move on to Capitaland Retail Trust by Teo Hong.
Hi, good afternoon, clients. Teo Hong here. I will touch on the results released by CRCT last week. So, all in all, FY17 they had a jump in the revenue of 7%. This is primarily due to the new acquisition that they had in September 16. And then there was rental growth from the multi-tenanted the malls in Beijing as well. Of all the malls that they had, Qibao was a bit weak. Qibao is in Shanghai, and this is the reason for the weakness is because of the competition in the vicinity. And then they also divested Anchen in July last year. But all in, revenue is up 7%. It's up 7%, slightly weaker than the 9.2% in RMB terms because of the weakening of the RMB versus the Sing on a year-on-year comparison basis. And as for DPU, it went up half a percent as a result of the higher number of units in issue. For performance on the portfolio wise, occupancy is stable at around 96%. Rental reversions inched up slightly from FY16. You see it in the table. I'll show you next in the next slide. And in the quarter, you also saw that they had a 3.7 million capital distribution from the divestment gains, and that is to top up the loss of income from that mall. And all in, they have a total divestment gain of 32 million, and that this pool can potentially be tapped on in case there is a shortfall of revenue going forward. So going forward for FY18, we expect DPU growth to be flat. The reason is because the new acquisition in Guangzhou Rock Square has already been completed last week. So you can expect contributions from that mall to come in Feb from this month onwards. But then we think that this will be likely offset by the higher number of units in issue because of the private placement that they did for this acquisition. So these two charts will basically sum up the call that we have. We are maintaining our neutral call. Our target price is 166. And if you look at the historical valuations of the REIT, is actually on the more expensive side. At a 6% yield is on the more expensive side of things. And if you look at rental reversions, this is one of our primary concern, is that the rental reversion actually ticked up this year versus last year. So this year they did 5.6%, but you see that tenant sales actually has not been following suit. It's actually on a weakening trend. There's a split between the two tiers. So in the tier 1, the bigger malls in Beijing, they're actually stabilizing at about low to mid single digit range, but there was a bit of weakness in the lower tier cities for CRCT. So all in, entire portfolio did about 1% growth. Okay, I'll next pass on to Richard.
Thank you, Hong. Yeah, now this is Richard speaking. We'll move on to SIA Engineering, which announced their results last Friday evening. We have upgraded the stock from neutral to accumulate, higher target price also to 351. We also raised our dividend assumption to 13 cents. 13 cents is the same as the previous FY. Originally our assumption was 12.5 cents. That will give, so 13 cents dividend will give you a 3.9% yield. That's based on last Friday's close of $3.33. For the results, revenue came in flat. Only 0.5% lower year on year, but you can see that for the core company EBIT, it was almost 30% lower. This was due to higher operating expenses, and that resulted in a lower operating margin of 6.7% this year compared to 9.3% last year. There was a positive surprise from the JV segment. So overall associates and JV, there was a 30% increase year on year to 40.8 million. Associates was just 0.6 million higher, or 3.5%, and the significant jump was from JV, which was 8.6 million. Take note here that core company operating profit is still quite weak, and most of the contribution to the bottom line is coming from the associates and JV level. Overall, PATMI was higher, 4.2% year on year, and net margin also slightly higher from 19.3% to 20.2%. So I mentioned here contribution from associated and joint venture companies. They grew almost 30%. This was driven by the repair and overhaul centers, where there was a 9.1 million increase year on year. So this 9.1 million is distributed here between joint venture and associates. Joint venture was 8.6 and associates was 0.6. I talked about this earlier already, the positive surprise from joint venture. So year on year, joint venture is higher by 60%, and quarter on quarter is close to 390% higher. So for joint venture wise, this repair and overhaul joint venture would refer to SASO. This is the joint venture with Rolls-Royce. So there was a sharp increase in the contribution from this side after 3 consecutive quarters of weak contribution. The previous 3 quarters contribution was less than 5 million, but this quarter is much higher. So this was despite the structural issue of new engines requiring less frequent servicing and lower work content. The other thing is associates remain stable, so this helped to buffer some of the weakness seen in the core company operating profit level. The core EBIT for the third quarter as well as the 9 months came in lower than our expectation and also consensus expectation, but nonetheless bottom line was better than expected. We have upgraded the stock to accumulate. We have adjusted some of our estimates for the associates and JV upwards. As I mentioned also, we have raised our dividend forecast to 13 cents. 13 cents is the same as last year, so yield should be stable. And why we think that the 13 cents is sustainable is that there's still some there's a positive free cash flow, and the SIA Engineering is receiving dividends from their associates and JVs. And lastly, the balance sheet is in a net cash position. So the company is cash rich and it has the ability to maintain the dividend level. Okay, we've come to the end of the webinar. We shall pause here for questions.
There's a question asking, do we see this sell down from the last few days actually continuing for a few more days? So in the chart previously that I've shown, this particular chart based on the S&P 500 index. So on the daily time frame, actually we are seeing some sort of a stabilization coming back to the market yesterday. So this particular big green bar that we are seeing right here is actually a bullish reversal candlestick pattern, and it's actually quite a big one considering how far we have actually dropped since last Friday. So we saw some bullish rebound since US open last night, and in terms of support wise, there is right now a strong support at the confluence of this 2,555 points as well as this 200-day moving average. And seeing how far we have dropped has actually brought the RSI back down to 25, which is oversold kind of a condition. Looking at the structure right now, it's definitely a better kind of outlook and a better kind of a structure for the market to rebound back higher rather than the period back then when we had the RSI that was overbought. So having an oversold RSI on 2 days ago actually kind of gave the market a better sensing, a better platform for it to actually bounce out higher. And looking at the price action, we believe this particular price action might be the next higher low point within this particular uptrend. And moving forward, we believe the S&P 500 kind of stabilize as suggested by our recession tracker for actually having another 8 more months of upside within the equity market as a whole. There's another question asking the reason for the start of a new bear market in Singapore. So we kind of use the US as a proxy for the rest of the market in terms of a risk on and risk off environment. And like I mentioned, our outlook for the US side of things, long term and near term wise, we still remain pretty bullish even after the sharp sell off that we've seen since last week. We believe the reversal that we are going to see in the coming days for the US market will actually kind of prop up the sentiment for the rest of the market, including Singapore market. So for STI wise, you can see price action wise yesterday we also have seen some rebound off its low, and as of today it's been hovering around unchanged. So all in all, I think we got to monitor what the US is showing moving forward. As long as this particular hammer over here kind of holds up, we believe the rest of the world in terms of the equity market should continue to move in the same direction as the US market.
Okay, there's another question. Any comments on Singtel recent price weakness? Okay, we do not cover Singtel, but I'll just give you some general comments on Singtel. Firstly, as you know, Singtel is facing new competition both in Singapore and also in Australia. So I can only say that whoever comes in, as you know, the fourth operator will be coming out soon, and this new fourth operator will definitely introduce a price plan that will be very aggressive, and it has to be lower than everyone else. Others, there's no point launching it. So as a result, we are just worried that until that time we could see a further violent price reaction on Singtel. I think once the new telco comes out with a lower price plan, then the market could react. Then we need to see some stability at least in how they do on the mobile pricing before we think Singtel will look attractive. So that watch for that event before you go back into Singtel. I think just our general comment. And also one last comment on telcos will be, the big one for telcos will be maybe next year or the year after when 5G comes about. This could actually be a new revenue stream, a new opportunity for the telcos. But until then, I think we will be very cautious on Singtel. Thank you.
Hi, this is Richard speaking. Yeah, there's a question asking whether SETS would be a better buy compared to SIA Engineering. First thing, no doubt, SETS outlook for SETS is better than SIA Engineering. However, you would be aware that SETS has gone up quite a bit already, and obviously the valuation may not be as attractive. And then if you look at SIA Engineering, if indeed the worst is over, this could be an opportunity to buy close to the bottom. And the last point is that take note that SETS has not announced their results yet. The results will be announced next week for the same quarter. So there, at this point, there isn't a basis to compare the performance for the two companies over the same period.
There's a question asking if we will actually cover our recession tracker on a weekly basis. For the recession tracker wise, we do it on a monthly basis. Reason behind is because economical data comes out more on a monthly basis than a weekly basis. That's why we are doing it on a monthly basis. So in terms of the report wise for the review for the recession tracker, we kind of follow the time frame of around 3rd to 4th week of the month to actually release the report. So we'll keep a lookout for the report on the 3rd and 4th week for the recession tracker. And as and when we see any huge move within the recession tracker, if any of the indicator actually triggers its threshold, we definitely will come out with an impromptu kind of report to let everyone know what's happening.
Hi, there's a question on Chip Eng Seng because it's quoted as one of our Singapore strategy picks. So our view for Chip Eng Seng is still the same. We believe that this will be a leverage proxy to the uptick in the Singapore property market because of the land bank and the existing inventory that they have. So they have this Woodleigh land bank that they won in July last year, and then existing inventory include the unsold portion of Grandeur Park. That project is about 87% sold. So together with High Park, these two projects are expected to contribute about 200 million in profits for the company over the next 2-3 years. And then so you also have the construction arm, whereby they recently also won another contract from HDB. That arm gives them about close to 20 million in profits on average over the last few years, and that amount alone is already enough to sustain the 4 cents dividend that they are paying out. So we think that the dividend is sustainable, number one. Based on current price, 4 cents dividend is a 4% yield plus potential capital upside from a good take-up rate at their launch, which will be expected to be in the second half of this year. So so do look out for the news of their launch. If there is news of good take-up rates, that will be a good catalyst for the share price as well. Our outlook for the S-REIT this year is still the same. It's a neutral because of the various macro headwinds that we think will occur this year. But then for the different sectors, we have different outlooks, and we think that this year is important that the earnings from the different sectors and the individual REITs are able to keep up to offset the headwinds on the macro front. So our accumulate calls for the sector remain as Ascendus REIT, Cash, and Dacian Retail Trust. There is also another question on Capitaland. Capitaland, why is it not performing as compared to other property counters? So over the last few months, or rather from March last year, when we saw that the government actually unwinded some of the cooling measures that they had, including the seller's stamp duty, and you saw that from then on, the momentum of property sales actually went up, including primary sales, secondary sales, and en bloc sales. So that led to a narrowing of the discount to RNAV for a lot of property counters, especially those with a lot of land bank. Those who have restocked in their land bank early on or have existing inventory. So on that front, Capitaland is not very huge on the Singapore market in terms of residential. So they are primarily in the retail space, the office space, the service residence space. But what people may not notice is that over the last few years, from 2013 to 16, they have been actually gradually building up their recurring income base from these few segments. So they actually have a pretty solid base of recurring income that has been growing at a CAGR of about 16% over the last, from 2013 to 16. So we think that this this recurring income could be is worth noting for the counter as well.
All right, since there's no more questions, we shall end the webinar here. But if you think of questions, you can go to Stocks BNB, that's our research website, and you can ask questions at Stocks BNB. Okay, see you again next week. And once again, sorry for the inconvenience caused on Monday due to technical difficulty. We couldn't have our webinar at the usual time.